Yes, welcome. This is KASNEB ATD Level 2, and we'll be discussing financial accounting and August 2021 paper. So August 2021 paper, financial accounting ATD Level 2. The question is on, looks like it's on sole proprietorship business. We are talking about Bob Mully. But before that, there's a theoretical question. So let's just tackle this theoretical question very fast and then move to our part B, which is a question on sole proprietorship. So, part A of the question: outline 5 challenges that could be faced by government and other public entities in implementation of international public sector accounting standards. Outline 5 challenges that could be faced by government and other public entities in implementation of IPSAS. Now, IPSAS is basically a set of accounting rules and guidelines that are supposed to be adhered and by the government entities majorly, and basically it's a set of rules that will guide the government entities on how to go about maintaining their financial records. And it's still a new concept to most of the governments, and some of them have already adopted. And of course, when we talk about challenges, we are talking about the teething problems in the process of implementing, because it's still a new concept. Most of the governments have implemented, some have not yet implemented. And so this question basically is asking, what are some of the challenges during implementation of the IPSAS? And some of the notable challenges that we have, let's just have it here. So solution, and then we'll start with part A of the question, challenges in implementation of IPSAS. Of course, the greatest challenge that we expect in implementing IPSAS is the skill gap. Because it's still a new concept to so many governments, so they are still trying to introduce. And being a new concept, of course, it has not been factored in most of the syllabuses. It's when it's being introduced into the syllabus, the system of education. So it means that there's a skill gap, and people who are already on jobs, it means that they have to do a lot of training to catch up with the new way of doing things. And of course, that will bring in some change management issues, which will also now come in as a challenge, especially when we talk about resistance. So there's some bit of resistance where people still want to do what they used to do, what they are comfortable with, which is the normal characteristic of people, that they prefer the comfort zone. So of course we have resistance, we have the skill gap, and the other obvious challenge that will come handy with this new development is the cost. So we can simply talk of the implementation cost. Of course, when we talk about skill gap, it means that we have to train these people. We have to, there's a lot of stuff that we have to do for people, for the systems to continue running as usual. And all these things that we have to do are resource intensive. They need money. They need budget allocated to them. So we can simply say that it's costly, and we have the implementation costs, which also come in as a challenge, especially when we already have budgets, or our budgets are constrained. Then the other problem also that is likely to come, or challenge, is the infrastructural and technological gap. You will not just introduce these things from nowhere. There is a lot of infrastructural development, the systems that have to be, put in place before the IPSAS. IPSAS is like a software, the way to do things, the way to maintain the financial records. But it goes with a lot of infrastructural and technological developments. And this might also pose a challenge in one way or the other, and they have actually posed a lot of challenges when we talk about the implementation of the IPSAS. The other thing is we can talk of the audits, the compliance, monitoring and evaluation part, monitoring and evaluation. You know, there's a way people are used to do things. And so learning all these things, the audit, the compliance, so that at the end of the day, you do your work and present your work in a normal way, definitely it will be tampered, it will be affected. And the moment these things like compliance, you know, rules change, the way you do things, you know, it affects the whole reason why we because accounting is about transparency, it's about presenting the information, and it's about ability to the uniformity, ability to for comparison, comparing your records and the other. So these changes, of course, will come in with a lot of issues, some which people understand, some people will embrace, but there are some which will not be embraced so easily, and so we expect it to affect the compliance levels, especially if there's a challenge with people when it comes to resistance and the group. Then also we have integration challenges, that is the changeover process. And especially when we also talk about the acts, like the PFM Act, Public Finance Management Act, and the IFNIS, you know, the integrating these things so that they can be in conformity, that can also be present a gap, present a challenge to the people who are using these things. So all these are some of the challenges. I'm just mentioning them. I hope the question just requires mentioning. Outline 5 challenges that could be faced by government, and it's only 5 marks. So you can talk of the skill gap, you can talk of change management issues, resistance, you can talk of the cost of implementation, you can talk of the infrastructural and technological developments. Here we're talking about the systems that will be required for this IPSAS to work efficiently. Then, of course, it will interfere with the audit, the compliance, monitoring, and evaluation processes. And in the process, we might lose some money in the process of trying to, change over. And of course, integration can also be an issue. So these are some of the challenges you can just talk about and go ahead and explain them if need be. But for this question, there's no need for explanation. So that is enough. Let's look at question 5B. So question 5B, and the question 5B is about this man called Bob Mooley, who runs a general supply shop but does not maintain full set of accounting records. The following information was extracted from his record. So we have summary of bank account. So balance at 1st August 2020. The year starts in 1st August 2020 and ends on 31st July 2021. So starting balance 3940, additional capital 40,000, cash from trade receivables 192,000, proceeds on sale of motor vehicle, that is van. Sorry, proceeds on sale of van. 4,200, total to 4,140. Then we have the payments, rent and rates 5,200, salaries and wages 30,200, payment to suppliers 44,000, purchases of motor vehicle 26,000, personal drawings 18,400, insurance 16,000, postage and stationery to 720, repairs and maintenance 1,300, motor vehicle 6,700, and balance 4,000. So additional information, trade payables, we have, now this becomes the accrual. Trade payables as at 1st August 2020, 9,400, as at 31st July 2021, 5,180. Same to trade receivables, accrued rent and rates. Motor van, we have the values there, prepaid insurance and inventory. Then Bob Mooley depreciates motor vehicles at the rate of 20% per annum on a straight-line basis. A full year's depreciation is provided in the year of purchase and no depreciation is charged in the year of disposal. All receipts are banked and all payments are made from business bank account. Then discount received from the suppliers during the year amounted to 2.2. A trade receivable of 600,000 owed by Wambu Enterprises and included in the trade receivables as of 1st July 2021 is to be written off. Good. So that is the additional information. You need to mark all those items that are there. For questions like this, it's always good to start with the workings. It's always good to start with the workings, especially since we have balances at the beginning and at the end. So they are quite massive. The workings will be massive, but we can see how to go about them. So required statement of profit or loss for the year ended that, and then statement of financial position for the year ended that, as at that 1st July 2021. That is the question, and as I have already said, questions like this, it's always good to start with the workings. But for the sake of time, I think we'll just work with them. We'll be doing the workings as we progress. Just make sure that you know everything that is under the additional information so that you don't skip any or you don't leave any unattended. So I think we are good to go, and we'll simply come here and start with this. We'll say this is Bob Molly, then say income statement for the year ended 31st July 2021, like that. So we have that, we have that. Then as usual, we need to have three columns so that we can also have ample space for workings. Then of course the other side will have the details. So we'll go straight to the sales, which is the trading account. Always start with the trading account. Sales less cost of sales, get gross profit. So from this question, allow me to be working somewhere here. From this question, what we are going to have is check our sales. The following information is extracted from his records. Summary of bank account for the ended that. So we have these receipts, we have these payments. And then, okay. So for the receipts, we have cash from trade receivables. We don't have sales directly, a direct sales figure given to us. So it means we'll have to work out. And sales is a function of the data. So we'll simply open here an accounts receivable account. So we have the credit side, we have the debit side. So let's see what we have for this account. So accounts receivable, that's where we are going to get the sales, because we sell to customers, and this is the whole amount that we received as a result of selling to the customer. Cash from trade receivables 192,000. Now, the easiest way to approach this is just remember that cash received from trade receivable, cash will hit the cash account. So it will be debited on the cash account. That automatically means that we are going to credit the accounts receivable account. And then the balance that we are going to start, this is accounts receivable, so it's an asset. So we'll come here and see how much we started with trade receivables. So we started with 14,640, we closed with 19,000 pending. So pending 19,000, we started with 14,640. And since the 14,640 is an asset, this is an asset because they are debtors, we'll simply come here and say balance brought down. How much? 14,640. And then of course the payments, bank side. This is bank, this is accounts receivable. So this is the amount they have paid to our banks. So you can see it's on the credit side. When it goes to the bank, it assumes the either bank or cash account, it assumes the debit side. When we receive money, it goes to the debit side of the cash or bank account. So here I will say bank account or cash account. How much are we talking about? Cash received from trade receivables 192,000. and then the balance carried down as per the question is this 19,000. So we will add the totals here. What do we get? This is 192,000 plus 19,000. That gives us 211,000. 211,000 minus 14,640. 14,640. That gives us 196,360. So we say this is to P and L. So P and L 196,360, and of course that is our balancing figure. So this is the accounts receivable accounts. That's how it will look like. So when you come to sales here, you simply replace with that figure. And let's see if we have workings. So check if we have workings. Let's just check the questions. The most notable working on sales is sales returns. So let's check if we have any sales returns. Check if you have any sales returns or anything that might affect the sales. Discount received from supplier, no, that one doesn't affect. So yes, we don't have a trade receivable 600 odd by trade receivables to be written off. Okay, this one will come in later. So since we don't have any workings, we'll capture the figure as it is. Let me just get the figure 196,360. So we come here 196,360. 196,360. Then we less the cost of sales, and under cost of sales we have the opening stock. Opening stock. Let's see if we have opening stock in this question. Yeah, definitely we have it. Opening stock 9,800. Most likely we will not have any working on that. So opening stock 9,800. Then we add what? Purchases. So let's see if we have purchases. And I doubt if we've been given purchases, because I can also see we have payment to suppliers 144,000. Why are we paying suppliers? Because they have basically supplied goods to us. So that means that we'll also have an accounts payable account. So this is credit, this is debit. And since this is a credit account by its nature, we will basically look at what we are closing, what we closed the year with. The year 2020 was 9,400, and then July we closed the year with how much? 5180. So we'll start balance brought down here. Remember, this is a credit account, balance brought down. So 9,400, this is the amount we had not paid. And then bank, how much did we pay? Payment to suppliers. So it is the bank that pays. So we will credit the bank and of course debit the payables account. This is the creditors. So that means that we are reducing on the liability. So bank account here, bank account, how much did the bank account lose? 144,000 in favor of accounts payable. And then how did we close the year? We closed the year with 5,180. So balance carried down how much? 5180, like that. That's how we go about it. So let's get the total. 144,000 plus 5180. This gives us 149,180, 149,180, 149,180 minus 94. That gives us 139,780. 139,780. This becomes the P and L account. The other easy way of reasoning this one out is this: if what we are doing here is not adding up, you are not understanding, then the easiest way to put it is like this: that we started the business with 14,640 owing. This is this is 9,400. This is 5180. This 5180 was outstanding for 2021. So this is an amount that belongs to, this financial period. So we'll simply take 5180. It was outstanding. We are supposed to pay the creditors, but we have not paid. So this is an amount that belongs to the financial period in question. So 5180 plus whatever it is that we have paid, which is 144,000. 144,000 minus what doesn't belong for this year. You see, this was for the previous year, 94. So minus 9,400, and we'll still get the same answer. The same thing we've done here. 144,000 plus 5180 minus 94. You'll get 139,780. 139,780. So that's the easiest way to look at it. You can just reason it out. But for the sake of workings, it's always good to show your workings, and this is how you can show the workings for that. Okay, so let's move on. Having done that, we found out that accounts payable is 139,780. So just come here, then say purchases 139,780, and let's see if we have workings. We need to check if we have any workings for purchases. If we have, we'll push it in the innermost column. Let's see if we have any workings for purchases. Purchase of motor vehicle, purchase. I don't know if we have any. So if we don't have, we go straight to inventory, 11,800. So less inventory, closing inventory, 11,800, closing inventory, 11,800, like that. So then we get that's 98 plus 139,780 minus 11,800. This gives us 137,780. 137,780 as the cost of sales. Then minus 196,360, and gives us 58,580. 58,580, and this becomes our gross profit. Our gross profit is 58,580. So if that is our gross profit, the next thing is to find out if we have any incomes and gains. So just say incomes and gains. That is, if we have, that is the next stage, incomes and gains. Do we have any incomes and gains? Let's check if we have any incomes and gains from the question. So incomes, gains, incomes, gains. There was a sale of motor vehicle at 4,200. Let's see what the value of that motor vehicle was. Normally, it's always good to compare the value of the motor vehicle as at the time it was sold. If the value is higher than what was sold, then that's a loss. But if the value is less than what was sold, then there is a gain. And normally we include that under incomes and gains. So proceeds on sale of motor vehicle 4,200. But how much was the motor vehicle sold at? I think that's the question. Let's find out how much the motor vehicle was sold at. Any information on the motor vehicle? Okay, so it means we'll go to the motor vehicle account. Motor van, cost is 20,000. Depreciation by the beginning of the year. This is when we are starting the year. So the cost was 20,000. You can see this is 20,000. Depreciation was 16,000. So the value of the vehicle at the start of the year was 4,000. So if the value of the vehicle at the beginning of the year was 4,000 and we've sold the vehicle at 4,200, then it means we have a gain of 200 shillings. So we say gain on sale of motor vehicle, and we simply show 4,200 minus 4,000. So this gives us, if we have any other income and gain, then we might want to put this here. But if we don't have any, we just push it to the outer column. So let's check if we have any. So that is I think that one is very clear, that the depreciation so far at the beginning of the year was 16,000. The cost was 20,000. So this gives us the value of the vehicle was 4,000, and then the vehicle was sold at 4,200. That means we gained 200. It's the 200 that we are interested with. So we have included it. We have basically credited the P&L account. That is P&L account that we are dealing with right now. So then I'm trying to check if I think there was some discount received. Yeah, discount received from the suppliers during the year amounted to 2,200. Please, these zeros, you need to assume them because they have not been restricted. So discount received from suppliers, because that's again discount received 2,200. So discount received, that is 2,200. And let's check if there's any other. So discount received, trade receivable, these are bad debt written off, all banks, only check. So I doubt if there's any other. So since there's no any other, you simply get the total like that. And this is 2,400. Add the other side. So 2,400, that gives us 6780, like that. 6780. Then we now come here and say expenses and losses, like that. So expenses and losses. So let's list all the expenses and losses. We go back here and we start from here, accrued rent and rates. So accrued rent and rates, we are starting with height, accrued rent and rates. I think we will not talk of accrued because this was so we just talk of rent and rates. Rent and rates. In fact, the best point to get this will be here. Yeah, payments. Yeah, so payments, rent and rates 5,200. And then we have the accrued rent and rates. So the easiest way to think to go around this, just try to reason out. Of course, if we start from this, these are payments. So the bank account was credited. So it means you're going to debit this account. Rent and rates is an expense, so it's definitely a debit account. So if we are to open this account here, we'll have something like this. Rent and rates account. So this is debit, this is credit. Then we'll have, of course, now the accrued rent. I was still explaining something that this is a debit account, accrued rent. This is rent that belongs to last year, what was not paid but belongs to last year. This belongs to this financial year, which was not paid. So if you want to find out the total amount of rent for this financial year, it's simply 520 plus 5,200 minus 400. That's how you go about it. But to express the same in accounting language, if you are to express the same in accounting language, we will say balance brought down, because this is an accrued. It will be on the credit side, so we'll say balance brought down. How much? 400. And then you say bank, because this money was paid from the bank account, so it's credit bank, then debit rent and rates. How much was paid? 5,200. Then how much is outstanding? Balance carried down. This will be 520. When you add this, you get 5720, and here also you get 5720. So the answer will be 5320, and this will be to P&L account. Sorry, there's a mistake we did here. This is not supposed to be P&L account, it's supposed to be trading account. Sorry for that. This is supposed to be trading account. We are dealing with trading account here, so it is supposed to be trading account. But the other one, rent and rates, that one is correct. That one is P&L account. So this one is trading account. We should know the difference between trading account and so that's okay now. Okay, so then let's look at I think we are done with that. So rent and rates, we simply bring this total here 5320. So we'll come here and say rent and rates 53.20, and we might say this is working 3. If this is our working, maybe let's call this working 1, and let's call this working 2, so that we have working 1, working 2, and working 3 here. This is working 1, this is working 2, and this is working 3, like that. So that's how we go about it. Yeah, so 53.20, good. Then we go pick the next one. The next one is salaries and wages, 30,200. Check around if we have any workings on salary and wages. Do you have any workings on salaries and wages? So we don't have. So salary and wages 30,200. Just write it as it is. Salary and wages. Salary and wages 30,200. Like that. Then we go pick the next one. The next one will be payment suppliers that are no. Purchase of motor vehicles, not an expense. Personal drawings, no, we don't capture there. Insurance 1,600. But insurance, there's something about insurance. Prepaid insurance. Yeah, so it means for insurance, we'll stop here, do our working for before we can progress. So insurance account. Insurance account. We'll have something like that. And just like the other one, insurance is also. No, this is an expense, so it's a debit account. But remember, this one is prepaid. Prepaid, here we're talking about prepaid. Prepaid, you paid in advance. So this was for this year. This is not for this year. So we'll come here and say balance. Balance brought down. Balance brought down. How much? 320, because it's for this year. Balance brought down 320. Then bank, how much was paid? I think it was 1,600. Let me just confirm that figure. Yeah, 1,600. And then balance brought down, since it's a prepaid, balance carried down. Balance carried down will be how much? The figure is 400. And so this will be to P&L account. So let's get the balancing figure. Get the balancing figure. This is 1920. This is 1920. So what we have here is 1520, like that. And we can call this our working for. So P&L 1520. So we simply come here and say insurance 1520, like that. Insurance 1520. Then we proceed. Insurance 1520. Postage and stationery 2720. Do we have any workings on postage and stationery? Postage and stationery, check. Postage and stationery, we don't have anything. So postage and stationery 2720. Postage and stationery 2720. Postage and stationery 2720. Next, repairs and maintenance 1300. Do we have any workings on repairs and maintenance? 1300. Repairs and maintenance, nothing. So repairs and maintenance 1300. Repairs and maintenance 1300. Next. Motor vehicle running expenses 67. We don't have anything on motor vehicle running expenses. So motor vehicle running expenses 67. Motor vehicle running expenses 6,700. Next, go to the next item. This is balance at the bank, so that one we don't. Okay, let's come back to the additional information. That one captured. Motor vehicle, the depreciation. We have depreciation, so we have the van and we also have the lorry. Okay, now here there's something. The lorry purchase of motor vehicle. We purchased a lorry 26,000. The motor van we sold. So So it means we'll not have any depreciation on the motor van unless, let me see what they are saying. There was something about, Bob Mully depreciates motor vehicle at the rate of 20% per annum on a straight line basis. A full year's depreciation is provided in the year of purchase. No depreciation is charged in the year of disposal. So it means for the van, we are not going to charge depreciation in the year of disposal, but the lorry which was purchased at 26,000, you can see, purchase of lorry 26,000, it's going to depreciate at the rate of 20%. So we simply take 20% of 26,000, which is 5,200. 5,200. So depreciation for motor vehicle, 5,200. Depreciation for motor vehicle, 5,200, like that. Then next, what are we supposed to do next? So we are done with that. Prepaid insurance, we are done. Inventory, we are done. We are done with item 2. All receipts are banked, we are done. Discount received, we are done. A trade receivable of 600 owed by one enterprise and included in the trade receivables as at that is to be written off. So this is bad debt written off, 600. Bad debt written off, 600. And I think that will mark the end of bad debt written off. Bad debt written off, 600. So that marks the end of the P&L account. The expenses. So let's add them. This will be 5320 plus 3200 plus 1520 plus 2720 plus 1300 plus 6700 plus 5200 plus 600. That gives us 53,560. 53,560. Then when we less this from what we have up there, we get 7220. 7220. We get 7220. So then this is 7220. Now I think we are done. We are done. What we have simply done is this 58,580 plus 2,400. We get 60. Wait a minute. This is 60. Sorry, there's a problem here. So this is 6980. 6980. 6980. 6980. So 6980 minus 53,560. This will give us 7420. So 9 minus 5 is 4. So 7420. Good. So that becomes our net profit. That becomes our net profit. That becomes our net profit, 7420. And I think we are done with the first part. Being a sole proprietorship, we don't have the appropriation account. So we'll go straight to the second part, which is the statement of financial position as at that date. We'll come here. That is the end of the first part. So this is 5B1. Let's now look at 5B2. 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 And this is Bob Mully. Bob Mully. Statement of financial position. Statement of financial position. As at 31st July 2021. As at 31st July 2021, like that. Then, as usual, we'll have our columns running. We'll have our columns running. So we'll have shillings and the restricted zeros, shillings and the restricted zeros, then shillings and the restricted zeros. So we'll start here with of course, we have the motor vehicles as our assets. Here we'll show the book value, then the accumulated depreciation. So can simply show the BV, then accumulated depreciation, and then here we have the net book value. That's what we are going to show in the 3 columns as pertains the non-current assets. So let's pick motor vehicle. I think the only motor vehicle we have now is this. The other one was sold off, so it's not there. So we'll just deal with this one. 26,000, and depreciation is 5,200. Do we have any other asset? We don't have any other asset, so we just come here and say asset motor vehicle. The figure is 26,000. Then depreciation is 5,200. So here we have 20,800. And I doubt if we have any other asset. If we don't have any other asset, we move straight to the current assets. So we don't have any other asset. So we move to the current assets. So let's move to the current assets. This was the non-current asset, and we have only one. So let's look at the current assets, and under the current assets we will of course we have bank, we have inventory, we have accounts receivable. No, these are things that are just there, so we can just pick them. So inventory, I remember inventory was here. Inventory 11,800. So just pick it. These are marks that you don't really have to think so hard for them. Bank also, the bank balance is here and it's obvious. So just pick the bank. Bank balance, proceeds on sale. Yeah, this is the balance at the bank. You can see 4,020. So let's get that balance at the bank, 4,020, like that. Then we go to accounts receivable. Accounts receivable, the figure was up there. You remember the working one? So accounts receivable 196,360. 196,360. Accounts receivable. So accounts receivable 196,360. Those are the debtors. So go back there, 196,360. Those are the sales. Sales is 196,360. Debtors, I think, just look at what was pending at the end of the year. Let's look at what was pending at the end of the year. Trade receivables, so it's 19,000. So 19,000, and remember we have bad debts of 600. So trade receivable is 19,000. Then let's bad debts written off. Bad debts written off, of course, from this figure. So this is 600. So what do we have? 18,400. Good. That is as far as accounts receivable is concerned. So 19,000 is what was pending at the end of the year. And let's check if we have any other current asset. Check if we have any other current asset. Of course, we have this prepayment. There's a prepayment here. Prepaid insurance of 400. So we'll come here and say prepaid insurance 400. Prepaid insurance. Prepaid insurance. How much is it? 400 shillings. And then what is remaining? What is remaining? Is there anything remaining? I doubt if there's anything remaining. Prepaid insurance, I think we've captured everything. So let's just get the total. Let's get the total. So this will be 4020. 4020 plus 11,800 plus 18,400 plus 400. That gives us 34,620. 34,620. And let's look at the current liabilities. So for the current liabilities, we have, of course, we have accounts payable. Accounts payable and they also have accrued rent and rates. Accrued rent and rates. So accounts payable, just go to the figure at the end of the year. Accounts payable somewhere here. Trade payables, we have 5180. Then accrued rent and rates 520. So 5180 and 220. There's something about these trade payables. You remember there was discount received from suppliers amounting to 2,200. So if this is the outstanding figure and they are given as a discount of 2,200, then we'll deduct from this. So 5180 minus 22, and then accrued rent is 520. So we simply come here and say accrued rent 520, and then for the accounts payable, we'll say the figure is 5180 minus 2200. This is the discount that was received from the suppliers. So 5180 minus 2200, that gives us 2980. So 2980 plus 520, this gives us 3,500. 3,500. Let's get the total. I hope we've not left anything out. So 2,800 plus 34,620 minus 3,500. This gives us 51,920. 51,920. 51,920. And this should be our net capital employed. Net capital employed. Then we come to the other side and say financed by. Financed by. So under financed by we have capital. And capital, our capital, we go back to the question to pick the capital. Have we seen the capital? Balance, beginning balance, additional capital, cash from trade receivables, proceeds on sale of motor vehicle, rent and rates, salaries and wages, payment to suppliers, purchase. Okay. The bank. The following balances are provided. Okay. It looks like we don't have the capital, so we'll have to compute. Let's just compute capital. Capital as at 30th. When was this? Capital as at 1st August 2020. 1st August 2020. 1st August 2020. So this will become our working five. So capital assets, we look at assets at the beginning of the year, then less liabilities. So forget about this because these are transactions that took place in the year. So we'll just come here and say trade payables, what we started with. Trade payables is a liability, so 94. So trade payables 9,400. Then next we have trade receivables 14,640. So trade receivables 14,640. Then motor vehicle accrued rent and rates. So this is accrued rent. This is 400. It's a liability. So accrued rent and rates 400, like that. Then motor vehicle at the end of the year, you can say the value was 4,000. That is cost minus depreciation. So motor vehicle 4,000. Motor vehicle 4,000. You're interested in the value. The assets are on the debit side. Then we're just distinguishing the assets and the liabilities. Then we have prepaid insurance 320. Prepaid insurance 320. This is an asset, it's a current asset. So prepaid insurance 320. Prepaid insurance 320. Then inventory 98. Inventory 9,800. Inventory 9,800. Then See if we have anything else. Balance at the bank. Remember there was something at the bank, this one here. Balance at the bank, opening balance. Remember this, balance in the bank, 3940. So bank balance, 3940. Bank balance, 3940. 3940. So check if there's anything we are leaving out, 3940. Then we've captured all these things at the start of the year. So that is it. So let's get the totals. Let's get the totals. Looks like it's obvious the asset side is greater than the liability. So 14,640 plus 4,000 plus 320 plus 98 plus 3940. This gives us 32,700. 32,700. So 32,700 minus 98. This gives us 22,900. So our capital brought down will be 22,900. So we simply come here and say capital working 5, 9,000, 22,900, like that. 22,900. Then additional capital, there was an additional capital, if I'm not wrong, of 40,000. So this makes the capital 62,900. 62,900. The additional capital is here. The additional capital is here. Additional capital 40,000. Yeah, so it makes it that. Then of course after that we add the net profit, which is down there, and then we less drawings. I saw there was drawings in this question. So the drawings is personal drawings 18,400. So we'll simply come here and say net profit. We add net profit. Net profit, I think it was 7420. Yeah, 7420. So we add 7420, and then we less drawings at 18,400. 18,400, like that. The answer we get should be just the same like what we got up there. So 62,900 plus 7420 minus 18,400. 51,920. Good. So we are good to go for 51,920, and then we call this net capital employed. Good. So we are done. Net capital employed 51,920. Net capital employed 51,920. That is the end of that question. It has balance. This is the financial statement showing financial position. This is a financial income statement or financial statement, and this is the theoretical part of the question. This question has taken us 53 minutes, but it's because we were doing it in a relaxed way. Otherwise, it should take you less than 30 minutes. Thank you. Subscribe and share. Success in your exams.